Joining me right now in a Fox Business Network exclusive is the chairman of UBS, Axel Weber, former president of the Bundesbank. Axel, it's wonderful to see you.
Morning, Maria.
Thank you so much for joining us. I want to start with the ECB because you've got such expertise when it comes to central bank policy, obviously, coming from the Bundesbank and all your experience on central banks. What was your take on the ECB's move yesterday? Was that warranted, that massive negative reaction?
Well, we talked to clients all over the week here in New York, and it was exactly what we expected, a 10 basis point cut into negative territory and another half year of prolongation of the program. What it shows, the market reaction, is that over the last 1 or 2 weeks, expectations started to run away about massive measures. And it just shows you how difficult it is when rates are at zero or negative and assets are already highly priced, how to add further stimulus. So we're seeing the additional benefits of further easing coming down, actually, being very, very close to zero. So these policies have run their way for 3 years, and adding to them will not really be a game changer for the economy.
So you need sort of fundamental change. I mean, not necessarily central bank moves, but fiscal policy that will move the needle.
Fiscal and
market demand.
Fiscal policy in Europe is also neutral to slightly stimulative, but what we need is structural reforms.
Right.
Europe has the same problems it had before the crisis. The expansionary fiscal and monetary policy pasted over some of the cracks in the European economy, but we still have competitiveness issues around Europe, especially in peripheral countries, and those problems need fixing. They're long-term fixes, and monetary policy is seeing the end of what it can do to add speed to the economy.
Does it bother you that we're seeing a difference in terms of what the ECB is doing and now what the Federal Reserve is about to start doing? We've got the jobs number out in about 45 minutes here. A lot of people think that's going to dictate what the Fed does. Explain to us the differences here and why it matters to see what the Fed is going to do in terms of raising rates and what the ECB is doing in terms of stimulus.
Right. So our expectation is that the U.S. economy can withstand a rate hike. Actually, it's been due for some time. We already expected with some probability for this to happen in September. We now think it's more or less a done deal for it to happen now. The job numbers today, and we've seen some great job numbers, last month around, unless they're really dramatically revised down and there is a bad reading, I think the rate cut will go ahead. And the job numbers will tell you more about the speed at which the Fed will continue to go over the next year, rather than really telling you whether or not they will move in December.
You've got so many clients across the world, and they're wondering what to do. How are they allocating capital right now in the face of all of this, and what are you advising clients to do right now?
Well, at the moment, clients are really sitting on exceptional amounts of cash.
What, like 30%?
No, it's
what
not
are the
that,
cash levels?
Well, it's not that high, but
okay.
In some portfolios it's 20%,
yeah.
and that's quite a lot. And clients have invested in equity much more than in fixed income. So we're also one of the largest world equity trader, and our business in the investment bank has been supported by people moving from fixed income into equity. In the U.S., that is starting to change. Valuations are already pretty high. We expect some further positive development on the stock markets, but European stock markets, we actually think, will recover more than U.S. stock markets, largely because they're still to some degree priced to a crisis level. There's more dynamics coming ahead in Europe, so Europe will recover at a slower pace than the U.S., but it will recover, and that's a good sign for stock markets in Europe. And monetary policy stimulus adds to driving investors into risky assets, and that is usually a strong support for the equity markets. Not there anymore to the same degree in the U.S., but it really is still there in Japan and Europe.
So it sounds like you're advising clients to shift some money or increase their money in Europe and Japan.
Yeah, we closed our U.S. equity overweight at the end of last year already, and we advised clients to overweight European equity and Japanese equity. So very clearly a shift in the regional focus of where that additional dollar is invested in diversified portfolios.
And does the currencies get in play there as well? I mean, do you recommend them do things in terms of, like, hedging out the currencies, given that you are saying you want to be allocated toward Europe and Asia?
Absolutely.
Yeah.
So whatever you would, if you don't hedge it out in an equity investment, you would lose again on the currency front. We've seen that in Japan. We're seeing it on the European side. So really, if you want to have a currency position, you should have an open currency position, a long dollar, short euro, or long dollar, short yen position, regulation. And I think at the moment it is very unclear whether that will continue to go much further.
Let me ask you a little about UBS's strategy. I'm glad just a minute ago you said, look, we're also among the largest fixed income traders. Analysts are wondering what the strategy is for the next, let's call it 3 or 5 years, because we all know that UBS was first in terms of shifting your strategy right after the big collapse in 2006 and 2007, focusing on the private bank, focusing on the wealth management division. That was very smart. Everybody followed suit. But now people are wondering, are you trying to get back knee-deep into investment banking? Or what's the story on capital markets businesses?
No,
what's the priority?
Yeah, so basically our priorities are unchanged, our strategy is unchanged. We used to allocate 2/3 of our capital to the investment bank, and we now only allocate roughly 1/3 of our capital to the investment bank, and that's unchanged. In the investment bank, we shifted the focus from being fixed income rates and credit business to now being corporate investment banking. So equity, corporate debt, M&A, advisory business, and those are the areas where we invest. But it is corporate business. It is something that supports the economy. It's something that helps economy and that helps economic agents and firms to invest. So we want to continue to do that business. We want to play an integral part in facilitating growth. And I think that's a good part of focus in the investment bank. Outside that, we want to be and continue to be the predominant world #1 wealth manager, and with the largest bank, with the largest market share in Switzerland. So that's our strategy. It's not changed at all.
It's a pretty good strategy and a pretty good position to be in, but the regulatory environment, we know, has dictated a lot of these changes. So given the fact that you're one of the largest banks, obviously largest in Switzerland and one of the largest in general, you are subject to much stricter regulations in terms of the Swiss National Bank, in terms of the Fed, all of the regulators out there, and yet you're competing with banks that are much smaller. You're competing with certain pieces of business that are much smaller, that do not face that kind of regulatory burden. So how do you grow in the face of that? So
first, on the new capital regimes, we already tick all the boxes for the regime where we need to be in 4 years' time. Our capital ratio is at 14.3%, common tangible equity. So we have one of the highest capital ratios of all our peer banks. We also have, in terms of our TLAC requirements, so the convertibles that we will have to issue, a very clear issuing plan over the next 4 years. It doesn't impact on our dividend policy. It doesn't impact on our strategy. So we've already done our homework, and we are where we need to be in a few years' time. The smaller players in the market do not face the same type of regulation when they enter into the market. But as they grow, they're subject to more stringent regulation as they become bigger. I would almost say that nowadays, the new capital liquidity management requirements, the whole regulation about resolvability, makes large banks have a huge advantage. It's almost like a market entry barrier to face all these regulatory costs. We face about 60,000 regulatory events every year globally. For you to have the departments to kind of be on top of all of these developments, and they're all relevant for a global bank, is a huge cost, and you need to be focused on that. So we're seeing the current regulation as something that will actually continue to bifurcate the market between the large global banks, who will hold their market share, and smaller players who want to enter into niche businesses, but I don't think they can penetrate the core of what banking is all about.
And this is the new normal. I mean, you're the largest. You've got the wherewithal to win, regardless of the regulatory environment. Real quick, I know everybody's doing budgets right now for 2016. What does 2016 look like? Where are you in terms of the cutting, in terms of FIC, financial, the financial investment bank part of the business? And are you done with cutting? And what does the budget look like for 2016?
Yeah, we have no intention to cut further. We said this year our strategy change are done. We're now focusing on implementing that strategy in a very disciplined fashion. We want to have next year as good a year as we're having this year. So knock on wood, it's not quite done, but it's been a good year for us. And I think what helps us today is we've done the capital transformation, we've done the strategic transformation, and now we focus on clients. It's all about serving clients, and the world out there is pretty complicated. It's pretty volatile, and clients appreciate a bank that is focused on them and helps them navigate these waters, and that's what we're trying to do.
No doubt about it. Dr. Axel Weber, always good to see you.
Good to see you, Maria.
Thank you so much. Axel Weber joining us, Chairman of UBS. And